everyone, welcome to your Monday Futures Market Outlook for February 7th, 2011. This is Patrick Sresna. For those of you that have not had the opportunity to try out eMiniSource.com's trading room, 5-day complimentary memberships are available on the website. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and when we plot an 80-week moving average, does a very good job to depict the bull and bear market cycles that the market has gone through. And back in mid-2009, when we crossed bullishly above that, the market has remained relatively focused on upside moves since. At this stage, we're still looking for a mid-1300 target on the upside. At some juncture, we do anticipate there's still to be profit taking. It'd be very unlikely that we would see even a 5-6 month rally without there being a multi-week profit taking cycle to split it up. Really, in the bigger picture, that doesn't make us bearish, but simply the farther this market goes here without that 5% correction, the stronger the magnitude of the correction will be when it actually begins. We think that correction will be a buying opportunity, so we're not in any way taking a bearish stance yet. When we take a closer look at that S&P 500 and the daily charts using the E-mini futures contracts, we had 2 distinct attempts by the bears to break this market down over the last couple of weeks. And each time there was simply no follow-through. The follow-through is the most important part to begin a corrective phase. With the bulls having reversed this and broken into higher highs, it is clear that we first have to have another leg on the upside before that profit-taking cycle begins. Really, we're now at this stage targeting a move up towards this 1325 to maybe even as high as the 1350 area on the upside of this leg. So there really actually is, in the bigger picture, only a marginal upside still to this market before we begin some profit-taking cycle. But at this stage, the bearishness that we had over the last 2 weeks, or the risk of bearishness in terms of profit-taking, simply has been now neutralized, and we have to see what levels these markets first go to before we look for another profit-taking cycle. Just to review our key points, we remain intermediate bullish for the first half of the year. Even though we anticipate a profit-taking cycle at some juncture, we still believe that will represent a buying opportunity. There continues to be momentum loss and a lack of market breadth, but that doesn't always have to stop a market in its tracks. The large caps like General Electric and Exxon and all these other ones are drawing this market to these higher levels from a market cap weighted perspective, but eventually they won't be able to advance any further unless the whole market breadth comes to support that rally. That's where the profit-taking cycle will begin. The bulls successfully fended off the first attempts for the bears to start that profit-taking cycle, so the window now remains open for testing higher zones before the profit-taking cycle begins. And even though we keep talking about that, anticipating that profit-taking cycle, again, just to emphasize that that probably will be a short-term buying opportunity, what will be a rally that should last for the first half of the year. When we take a closer look at the NASDAQ 100, we can also see that sideways little flagging formation is now in a position to potentially bullishly break out. Really at this stage, if we have the NASDAQ break to higher highs, looking for somewhere in the 2400 to 2450 area would be some reasonable first targets on the upside. Next, I want to take a look at the U.S. dollar index, and the U.S. dollar weakness has really been something that's fueled this commodity rally and subsequently this entire trend that's been in place of weaker bonds and so on. And really at this stage, the U.S. dollar is bouncing a little bit with that short-term low coming around the 77, 77.50. We could see a bounce, even retest the 79 or even higher level on the upside. But at this stage, there simply is not enough evidence to conclude that this U.S. dollar is done selling. That blue box represents the retracement zones, and as soon as we get into there, the U.S. dollar index could roll back down and even head down toward the 75, 50, 76 area where the lows came in October and November. So we're not in any way looking for a big reversal here. That doesn't mean we can't have a week of strength of the dollar back up towards the 79 level, but we'd be still skeptical about its sustainability until the trend is really put in a solid bottom. Next here, I want to take a look at the gold futures contracts. And when we look at gold, we've seen a short-term low come in that 1310, 1330 area we've been talking about. At this stage, we're now seeing this kind of flagging rally back. We were talking last week about that 1360 area. We marked off the blue box in terms of, again, the retracement zones. And just like the dollar, we're anticipating that gold should struggle in these levels. If we see gold struggling here, there should be one more retest of the support lines. Either it goes down back for a double bottom retest of the 1310 area, or we could have one more deeper test that could even potentially go as low as the 1240 area on the downside. We're not in the big picture bearish on gold at this juncture, but we do anticipate that this profit-taking cycle needs to finish itself off and base out gold before the buying opportunity will emerge. Next year, I'm going to take a look at crude oil futures, and we more or less had a pop for another retest of that 91.50, 92.50 focal point on the upside. We reversed back down, and we again have almost like another double top retest of that zone. Now, if everything in Egypt sort of calms down, geopolitical concerns that spiked oil could create some relief selling that could come all the way back down to retest the lows around the 85, 86 area. There's a lot of price action confusion and a lot of political things that are going on that could be driving a catalyst for oil. There would take a new crisis to really occur, I think, to push crude oil up into that 94, 96 target. That is up there is actually where a measured move does lie. But if we have any breaks below 85, 86 on the downside, it would actually spark a much deeper correction in oil. So right now we remain relatively neutral, looking to see where support lines are held and how price action develops here in order to gauge where we want to go. At this stage, it's really hard to make a direct forecast on this play. Finally, I want to look at that 10-year Treasury note, and as that weakness in the dollar came in, the Treasury bonds finally broke this flagging formation we've been talking about for a couple months, and more or less we now are at a critical level where it's retesting that 118.5 to 119 area on the downside. We could temporarily get even a 1 or 2 day bounce back on the upside, but in the bigger picture, if we have any legitimate closes to new lows, that will actually draw a lot of new short interest into the Treasury note, which could see at 115, 117 on the downside. In the bigger picture, we think the 10-year and the 30-year Treasury notes may eventually bottom at some point this year. But at this stage, the trend is lower, and we don't want to be trying to bottom fish at this market at this time. That was your Monday Futures Market Outlook. Thank you for joining me.